hard to judge corporate culture in the foreign countries as well as we can judge it in our own.
Area 5.
Yvonne Edmonds from Cedar Mountain, North Carolina. I have a specific question, but not a trivial one. You regularly compare Berkshire Hathaway's performance to the S&P 500, which is very helpful and very interesting. But I haven't seen a correlation coefficient between the S&P 500 daily, from day to day performance, close, say, and Berkshire Hathaway's close. Now, it so happens for me, and I'm sure some other people in the audience, that I don't always have access to newspapers, or the internet for that matter, newspapers that publish Berkshire Hathaway performance on a daily basis, or even a weekly basis for that matter, or a monthly basis. It would be very helpful to know the extent of a correlation coefficient between those two variables. If you have that, would you let us know what it is? And if you don't, would you please consider calculating it in the future?
Well, it could be calculated, but I don't think it would have much meaning. I mean, it would be an historical correlation coefficient, which, you know, I would be very reluctant to have people place any weight in. I try to indicate even the limitations of the yearly comparison of the relative performance, because what was doable by us in the past is not doable today. I mentioned in my annual report the best decade I ever had on comparative performance by far was the 50s. Now, I don't think it was because I was a lot smarter then. I'm unwilling to accept that. But, you know, I had some edge of, well, there's probably 40 plus points per year. But I was working with it. That has no relevance to today whatsoever. It would be misleading to publish it or to make calculations based on it. So I think that you would find, I don't know what you'd find on a specific correlation between Berkshire and the S&P. You'd find a lot of correlation. Well, you might not find so much even. You'd find it in intrinsic value between that and Coke and a few stocks like that. But I don't really think that's particularly useful information going forward. We'd have no objection if anybody wants to make the calculation, but it wouldn't be something that would be of any utility to us. And if we don't think it's of utility to us, we don't want to put it out for shareholders as being a possible utility. We do think that the S&P annual calculation has some meaning because it's an alternative for people to invest. They don't need us to buy the S&P. So unless over time we have some advantage over that, you know, what are we contributing? What value is added by our management? So we think that people should hold us accountable, even though we would prefer not to be, because that it is a tough comparison for us as a tax-paying entity against the pre-tax calculation on the S&P. But we don't pay any attention to beta or any of that sort of thing. It just doesn't mean anything to us. We're only interested in price and value, and that's what we're focusing on all the time. And any kind of market movements or anything don't mean anything. I don't know what Berkshire is selling for today, and it really makes no difference. You know, it just doesn't make any difference. What does count is where it is 10 years from now. And I can't tell you what it was selling for on May 4th, 1983 or May 4th, 1986. So I don't care what it sells for on May 4th, 1998. I do care, you know, where it is in general 10 years from now. And that's where all the focus is. Charlie?
Yeah, we're publishing data in the form where we would like it if we were the passive shareholder. And so you're getting the data and you're getting it on a time schedule based on what we would want if we were in your position. And we don't think the correlation coefficients would help us.
We don't think anything that relates either to volume, price action, relative strength, any of that sort of thing. And bear in mind that when I was in my teens, I used to eat that stuff up. I mean, I was making calculations based on it all the time, and kept charts on it, and even wrote an article or two on it. But it just has no place in the operation now.
One of the pleasant things about dealing with Warren all these years is he's never talked about a correlation coefficient. If the correlation isn't so extreme you can see it with the naked eye, he doesn't compute it.
Yeah. Okay, we're going to go to Zone 6, and I'm going to have a dilly bar, and Charlie's got one here too. These are terrific.
My question has to do with what you mentioned earlier about how companies have to reinvest a certain amount of cash in their business every year just to stay in place. And if one could say that the best businesses are the ones that not only throw off lots of cash, but can reinvest it in more capacity. But I suppose the paradox is that the better a company's opportunities for making expansionary capital expenditures, the worse they appear to be as consumers of cash rather than generators of cash. What specific techniques have you used to figure out the maintenance capital expenditures that you need to do in order to figure out how much cash a company is throwing off? What techniques have you used on Gillette or other companies that you've studied?
Well, if you look at a company such as Gillette or Coke, you won't find great differences between their depreciation. Forget about amortization for the moment, but depreciation and sort of the required capital expenditures. If we got into a hyperinflationary period, or I mean, you can set up cases where that wouldn't be true, but by and large, the depreciation charge is not inappropriate in most companies to use as a proxy for required capital expenditures, which is why we think that reported earnings plus amortization of intangibles usually gives a pretty good indication of earning power. And I've never given a thought to whether Gillette needs to spend $100 million more, $100 million less than depreciation in order to maintain its competitive position. But I would guess the range is even considerably less than that versus its recorded depreciation. The businesses you have to worry about, I mean, an airline business is a good case. In airlines, you just have to keep spending money like crazy, and you have to spend money like crazy if it's attractive to spend money, and you have to spend it the same way if it's unattractive. It's part of the game. Even in our textile business, to stay competitive, we would have needed to spend substantial money without any necessary, any clear prospects of making any money when we got through spending it. And those are real traps, those kind of businesses, and they may work out one way or another, but they're dangerous. And in a See's candy, we would love to be able to spend $10 million, $100 million, $500 million and get anything like the returns we've gotten in the past. But there aren't good ways to do it, unfortunately. We'll keep looking. But it's not a business where capital produces the profits. At flight safety, capital produces the profits. You need more simulators as you go along, and more pilots are to be trained, and so capital is required to produce profits. But it's just not the case at See's. And at Coca-Cola, particularly when new markets come along, the Chinas of the world or East Germany or something of the sort, the Coca-Cola company itself would frequently make the investments needed to build up the bottling infrastructure to rapidly capitalize on those markets, the old Soviet Union. So those are expenditure. You don't even make the calculation on them. You just know you've got to do it. You've got a wonderful business and you want to have it spread worldwide, and you want to capitalize on it to its fullest. And you can make a return on investment calculation, but as far as I'm concerned, it's a waste of time because you're going to do it anyway. And you want to dominate those markets over time. And eventually, you'll probably fold those investments into other bottling systems as the market gets developed. But you don't want to wait for conventional bottlers to do it. You want to be there. One of the ironies, incidentally, it might get a kick out of some of the older members of the audience, that when the Berlin Wall went down and Coke was there that day with Coca-Cola for East Germany, that Coke came from the bottling plant at Dunkirk. So there was a certain poetic irony there. Charlie, do you have anything on that?
I've heard Warren say since very early in his life that the difference between a good business and a bad business is usually that a good business just throws up one easy decision after another, whereas the bad business gives you a horrible choice where the decision is hard to make. And is this really going to work? Is it worth the money? If you want a system for determining which is a good business and which is a bad business, just see which one is throwing the management bloopers time after time after time. Easy decisions. It's not very hard for us to decide to open a new Sears store in a new shopping center in California that's obviously going to succeed. It's a blooper. On the other hand, there are plenty of businesses where the decisions that come across your desk are just awful. And those businesses, by and large, don't work very well.
I've been on the board of Coke now for 10 years, and we've had project after project come up, and there's always an ROI, but it doesn't really make much difference to me because in the end, almost any decision you make that solidifies and extends the dominance of Coke around the world in an industry that's growing by a significant percentage and which has great inherent underlying profitability, the decisions are going to be right. And you've got people there that will execute them well.
You're saying you get blooper after blooper.
Yeah. And then Charlie and I sat on U.S. Air, and the decisions would come along, and it would be a question of, do you buy the Eastern Shuttle or whatever it may be, and you're running out of money, and yet to play the game and to keep the traffic flows such as with connecting passengers and everything, you just have to continually make these decisions, whether you spend $100 million more on some airport, and they're agony, because, again, you don't have any real choice, but you also don't have any real conviction that it's going to translate, those choices are going to, or lack of choices, are going to translate themselves into real money later on. So one game is just forcing you to push more money into the table with no idea of what kind of a hand you hold, and the other one, you get a chance to push more money in, knowing that you've got a winning hand all the way. Charlie? Why'd we buy US Air? Could have bought more Coke. Area 7.
My name is Bakul Patel. I am from upstate New York. My question is Berkshire prepared for 1929 style of depression or like a prolonged bear market that exists in Japan? 1929 style of depression or like a prolonged bear market that exists in Japan?
Well, we don't expect what you're talking about, but we're probably about as well prepared as any company can be for adversity because Berkshire has been built to last. Net, we would benefit over a 20-year period by having some periods of terrible markets periodically in that 20-year period. That doesn't mean we're wishing for them, and it doesn't mean they're going to happen. But we make our money by allocating capital well, and the lower the general stock market would be, the better we can allocate capital. So we're well prepared, but we're not necessarily expecting. Charlie?
Yeah, we are not going to ever sell everything and go to cash and wait for the crash so we can go back in. On the other hand, we are structured so that I think net a lot of turmoil in the next 20 years will help us, not hurt us. I don't mean it'll be pleasant to go through the down cycle, but it's part of the game.
Area 8.
My name is Pete Banner from Boulder, Colorado. First of all, Mr. Buffett and Mr. Munger, thank you for your genuine generosity today. Berkshire closed yesterday. The A share was about, for Friday, $69,000, and the B share was about $2,300. Do you feel that price is grossly overpriced or grossly underpriced or reasonably priced?
Well, I'll let Charlie answer that one.
I'm not going to say.
No, we're just never going to, we're never going to give out advice on Berkshire stock. There's no, that is up to people who want to buy and sell it. And anything we would say could easily get magnified, and people would be acting on it months later, and who knows all the problems that it could produce. So
it would be quite eccentric if we were to every day put out an announcement, now's the time to buy, now's the time to sell our own stock. Eccentric we are, but that eccentric we aren't.
Area 9.
I'm Irene Finster, your longtime partner from Tulsa, Oklahoma.
Hi, Irene. Yeah, Irene has a soda fountain. You ought to go visit her.
First, I want to thank you for giving your shareholders the opportunity to select their own charities. And second, I'm very concerned about your health due to your diet of red meat.
Irene, these are our products that I'm eating.
red meat, candy, ice cream,
and that's just what I do. That's what I do in public.
And Cokes. And I want to know what your doctor says.
My doctor says I must be heavily relying on my genes. Now, I will tell you, I mean, Charlie and I are both very helpful. If you were in the life insurance business, you would be happy to write us at standard rates, I can assure you.
They asked George Burns when he was 95, what does your doctor say about smoking these big black cigars? And he said, my doctor's dead.
Charlie and I played bridge with George when he was about 97, I'd say, at the Hillcrest Country Club, and there was a big sign behind him that said, no smoking by anyone under 95. And actually, at his 95th birthday party, he had about 5 very good-looking young girls that were there to greet him with a big cake and everything, and he looked them over one after another, and he said, oh, girls, he said, I'm 95. One of you is going to have to come back tomorrow. We're very big on George Burns in recent years. Area 10.
My name is Hubert Vos. I'm from Santa Barbara, California. Earlier this morning, you made a comment that if the market fell, you would be spending less time on the internet because you'd be very busy. And this has reinforced an impression I have had that the cash flows of Berkshire Hathaway are enormous, but that possibly in the last 12 months you've been investing less than you had previously. And if so, if this is correct, what does that say about waiting for attractive values? How long are you willing to wait? And what does that say to the investment public in their own habits?
Well, you're correct that we have not found anything to speak of in equities in a good many months. And the question of how long we wait, we wait indefinitely. We are not going to buy anything just to buy something. We will only buy something if we think we're getting something attractive. And incidentally, if things were 5% cheaper, that or 10% cheaper, that wouldn't change anything materially. So we have no idea when that period ends. We have no idea whether. So we have no idea when that period ends. We have no idea whether if on equity stay where they are, but they are, even then they aren't in the least mouth-watering. So we won't feel we've missed anything particularly if returns stay where they are, because if it turns out that these levels are okay, they still will not produce great returns from here in our view. That doesn't mean you couldn't have a tremendous market in the short term or something of the sort. I mean, markets can do anything. I mean, you look at the history of markets and you just see everything under the sun. But we will not, we have no time frame. If the money piles up, the money piles up, and when we see something that it makes sense. We're willing to act very fast, very big, but we're not willing to act on anything that doesn't check out in our view. You don't get paid for activity. You only get paid for being right. Charlie?
Yeah, an occasional dull stretch for new buying. This is no great tragedy in an investment lifetime. And other things may be possible in such an era too. I mean, it isn't like we have a quiver with only one arrow.
We sat through periods before. I mean, the most dramatic one being the early 70s, late 60s and early 70s. For a long time, doesn't seem so long when you look back on it. It seems long when you're going through it, but it's like having a tooth pulled or something. But it's, what can you do about it? The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like. We'll love it when we can swing in a big way, though. That's our style. Area 1?
Larry Pikowski, Millburn, New Jersey. Berkshire seems never to have made any pure real estate investments, with not counting facilities the operating companies might own, with the exception of Wesco's involvement in the residential project in California. I was wondering if you've ever looked at a real estate transaction and tried to apply the same filters, meaning competitive advantages, returns on capital, that you do in operating companies. And if not, is it a circle of competence issue, or is there something you find disinteresting about real estate?
You want to take it? Yeah. Okay, Charlie wants to take this one.
Let me take this one because here's a area where we have a perfect record that extends over many decades. We have been demonstrably foolish in almost every operation that had to do with real estate we've ever touched. Every time we had a surplus plant and didn't want to hit the bid and let some developer kind of take an unfair advantage of us, we would have been better off later if we'd hit the bid and invested the money in fields where we had the expertise. That housing track that I developed because I didn't want to let the zoning authorities rob me the way they wanted to. I wish I had let them. We have a certified record of failure in this field.
And the funny thing is we understand real estate.
Yeah, and we're good at it. Right.
But that actually is a correct aside. We do understand real estate. And Charlie got to start in real estate.
Yeah, but we understand other things better. And so the chances that we're going to be big in real estate are low.
Yeah. We've seen lots of things, and the prices just don't intrigue us in terms of what we get for our money. I tried to buy a town when I was 21 years old. The U.S. government had a town in Ohio for sale, and would have worked out very well. There's nothing about the arena that turns us off, but we don't see great returns available, and like Charlie says, the few things, particularly having an old plant or something, we have not been great at working our way out of those. Fortunately, they haven't been very important in relation to the net worth of Berkshire. Area 2?
Good afternoon. My name is Fred Castano from Detroit, Michigan. My question concerns Nike. Nike is a company experiencing some short-term problems, but is a great company with an excellent track record. Phil Knight is similar to Bill Gates in the respect that he's a marketing genius and is a very hard worker. Making sneakers is a very simple business with high margins. How do you view Nike, and what do you think of the company?
Well, I think Phil Knight is a terrific operator. I think, and he's a competitor. He's got a lot of money in Nike, but in terms of what we think of the stock, we keep all of those views to ourselves pretty much. Area 3.
Hello, my name is Ed Clinton. I'm from Chicago, Illinois. I'm wondering about the tobacco litigation. there's also have been some comments about fatty food. Do you think there's going to be a new trend of fatty food litigation coming out of the tobacco problems?
Well, I sign a waiver before I do any of that myself. No, I would doubt. I do not see those two as being remotely similar. But, Charlie, do you have any different views on that?
Well, I think the traditional tort system is particularly ill-suited for solving what might be called the tobacco health problem. So I regard that whole thing as sort of a Mad Hatter's Tea Party. And we sit out from afar.
Area 4.
Yes, I'm Fred Bunch from near Tightwad, Missouri. In light of the current...
What was the name of that town?
Tightwad, Missouri.
Tightwad, Missouri, huh?
There's a bank there.
Oh, did they name it after me or Charlie?
Well, neither one, really. You'd both fit in. In light of today's healthy growth and stability of the American economy at the present time and over the last 5 years or so, how much credit, if any, do you give the Clinton administration and why?
Well, I give credit to going back to Volcker, significant credit to Volcker. I give credit to Reagan, going back to Volcker, significant credit to Volcker. I give credit to Reagan, certainly to Greenspan and to Rubin. And the tax bill was very important, carried by one vote, and I think he may listen to Rubin. So I think there's a lot to give credit for, and I think you can spread it around a fair amount. Charlie may be less charitable here, but let's see.
No, I've got no great quarrel with the way the country's economy is performed. I think it's way better than any of us would have predicted.
Area 5.
My name is Travis Keith. I'm from Dallas, Texas. And my question regards what Philip Fisher referred to as scuttlebutt. When you've identified a business that you consider to warrant further investigation, more intense investigation, how much time do you spend commonly, both in terms of total hours and in terms of the span in weeks or months that you perform that investigation over?
Well, the answer to that question is that now I spend practically none because I've done it in the past. And one advantage of allocating capital is that an awful lot of what you do is cumulative in nature, so that you do get continuing benefits out of things that you've done earlier. So by now, it's cumulative in nature, so that you do get continuing benefits out of things that you've done earlier. So by now, to the businesses that might qualify. But when I started out, and for a long time, I used to do a lot of what Phil Fisher described. I followed his scuttlebutt method, and I don't think you can do too much of it. Now, the general premise of why you're interested in something should be 80% of it or thereabouts. I mean, you don't want to be chasing down every idea that way, so you should have a strong presumption. You should be like a basketball coach who runs into a 7-footer on the street. I mean, you're interested to start with. Now you got to find out if you can keep him in school, if he's coordinated and all that sort of thing. That's the scuttlebutt aspect of it. But I believe that as you're acquiring knowledge about industries in general, companies specifically, that there really isn't anything like first doing some reading about them and then getting out and talking to competitors and customers and suppliers and ex-employees and current employees and whatever it may be. And you will learn a lot. But it should be the last 20% or 10%. I mean, you don't want to get too impressed by that, because you really want to start with a business where you think the economics are good, where they look like 7-footers, and then you want to go out with a scuttlebutt approach to possibly reject your original hypothesis, or maybe and if you confirm it, maybe do it even more strongly. I did that with American Express back in the 60s, and essentially the scuttlebutt approach so reinforced my feeling about it that I kept buying more and more and more as I went along. And if you talk to a bunch of people in an industry and you ask them what competitor they fear the most and why they fear them and all of that sort of thing, you know, who would they use the silver bullet of Andy Groves on and so on, you're going to learn a lot about it. You'll probably know more about the industry than most of the people in it when you get through, because you'll bring an independent perspective to it, and you'll be listening to everything everyone says rather than coming in and with these preconceived notions and just sort of listening to your own troops after a while. And I advise it. I don't really do it much anymore. I do it a little bit, and I talked in the annual report about how when we made the decision on keeping the American Express when we exchanged our perks for common stock in 1994, I was using the scuttlebutt approach when I talked to Frank Olson. I couldn't have talked to a better guy than Frank Olson. Frank Olson, running Hertz Corporation, lots of experience at United Airlines, and a consumer marketing guy by nature. I mean, he understands business. And when I asked him how strong the American Express card business, and when I asked him how strong the American Express card, I mean, he could give me an answer in 5 minutes than I could accomplish in hours and hours and hours or weeks of roaming around and doing other things. So you can learn from people, and Frank was a user of it. I mean, Frank was paying X percent to American Express for his Hertz cars, and Frank doesn't like to pay out money, so why was he paying that? And if he was paying more than he was paying on Master, Charge, or Visa, why was he paying more? And what could he do about it? I mean, you just keep asking questions. And I guess Davey explained that in that video we had ahead of time. I'm very grateful to him for doing that, because that was a real effort for him. But that was really what I was doing back in 1951 when I visited him down in Washington, because I was trying to figure out why people would insure with Geico rather than with the companies that they were already insuring with, and how permanent that advantage was, and you know, what other things could you do with that advantage? And you know, there were just a lot of questions I wanted to ask him, and he was terrific in giving me the answers. It you know, changed my life in a major way. So I've got nobody to thank but Davey on that. But that's the scuttlebutt method, and I do advise it. Charlie?
Nothing to add.
Area 6?
Hi, my name is Richard Lontoc from Toronto, Canada. I have a question for both of you. Mr. Buffett, Berkshire Hathaway's earnings in 1997 is less than that of 1996. What do you intend to do in 1998 to improve that earning? And Mr. Munger, I've been watching you and Mr. Buffett eating the See's candies and drinking the Coca-Cola the whole day.
Join in.
Do you intend to do any commercials in the future like what Dave Thomas does with Wendy's?
Which of us do you think we should do them? Now you're talking.
We aren't old enough to be really good in a commercial. What we would like to do is have somebody up here happily eating See's candy and answering these questions who's about 110 years old. That would really be helpful.
In terms of the earnings, the final bottom line GAAP reported earnings that mean absolutely nothing at Berkshire to us. Now the look-through earnings, which we publish, do have some meaning, but even those have to be interpreted in terms of whether there was a super cat occurrence or whether Geico had an unusually good year, and we try to mention those factors. But we do hope that the look-through earnings do build at a reasonable clip over time. But our final earnings include capital gains, and we can report those in any number that we wanted to, and we pay no attention whatsoever to realize capital gains at Berkshire. The IRS does, but and that's why we may send them $1 billion or more this year. But they mean nothing in terms of measuring our progress. The look-through earnings say something about it. That table, the first couple of pages, that shows our change in book value versus the S&P, says something about it. Not perfect. The real test is the gain in intrinsic value per share over time, and that there's no hard number for that. But so far, Charlie and I judge it satisfactory, but we also judge it as non-repeatable. Charlie, any more?
No.
Area 7, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Keiko Mihalik. and I'm an MBA student at Wharton, but please don't hold that against me.
We won't. I never made it that far. I was an undergraduate student.
Could you please explain how you differentiate between types of businesses in your cash flow valuation process, given that you use the same discount rate across companies? For example, in valuing Coke and Geico, how do you account for the difference in the riskiness of their cash flows?
We don't worry about risk in the traditional, the way you're taught actually at Wharton. But it's a good question. Believe me. But if we could see the future of every business perfectly, it wouldn't make any difference whether the money came from running streetcars or from selling software, because all the cash that came out, which is all we're measuring between now and Judgment Day, would spend the same to us. The industry that it's earned in means nothing except to the extent that it may tell you something about the ability to develop the cash, but it doesn't tell you, it has no meaning on the quality of the cash once it becomes distributable. We look at riskiness essentially as being sort of a go, no-go valve in terms of looking at the future of businesses. In other words, if we think we simply don't know what's going to happen in the future, that doesn't mean it's necessarily risky. It just means we don't know. It means it's risky for us. It may not be risky for someone else who understands the business. In that case, we just give up. We don't try to predict those things. And we don't say, well, we don't know what's going to happen, so therefore we'll discount it at 9% instead of 7%, some number that we don't even know. That is not our way to approach it. We feel that once it passed the threshold test of being something about which we feel quite certain, that the same discount factor tends to apply to everything. And we try to do only things about which we're quite certain when we buy into the businesses. So we think all the capital asset pricing model type reasoning with different rates of risk-adjusted return and all that, we tend to think it is, well, we don't tend to, we think it is nonsense. And but we do think it's also nonsense to get into situations or to try and evaluate situations where we don't have any conviction to speak of as to what the future is going to look like. And we don't think you can compensate for that by having a higher discount rate and saying it's riskier so that I don't really know what's going to happen, I'll have a higher discount rate. That just is not our way of approaching things. Charlie?
Yeah, this great emphasis on volatility in corporate finance, we just regard as nonsense. If we have a statistical probability of putting out $1 million and having it turn into put it this way, as long as the odds are in our favor and we're not risking the whole company on one throw or anything close to it, we don't mind volatility in results. What we want is the favorable odds. We figure the volatility over time will take care of itself at Berkshire.
If we have a business about which we're extremely confident as to the business result, we would prefer that it have high volatility than low volatility. We will make more money out of a business where we know where the end game is going to be if it bounces around a lot. I mean, for example, if people reacted to the monthly earnings of Seas, which might lose money 8 months out of the year and makes a fortune, in November and December, if people reacted to that and therefore made its stock as an independent company very volatile, that would be terrific for us because we would know it was all nonsense, and we would buy in July and sell in January. Well, obviously things don't behave that way, but when we see a business about which we're very certain, but the world thinks that its fortunes are going up and down, and therefore it behaves with great volatility, we love it. That's way better than having a lower beta. So we think that we actually would prefer what other people would call risk When we bought the Washington Post, I've used that as, it went down 50% in a matter of a few months. Best thing that could have happened. I mean, that doesn't get any better than that. Business was fundamentally very non-volatile in nature. I mean, TV stations and a strong dominant newspaper, that's a non-volatile business, but it was a volatile stock. And that is a great combination from our standpoint. Area 8.
Good afternoon, and thank you for staying around to answer our questions. I have two. First of all, would you give us what logic went into your decision to both buy and sell McDonald's? And my second question goes to a term that you've used. You've talked about the caliber of the shareholders of Berkshire Hathaway. How do you define the caliber, and what difference does it really make?
Well, it makes a lot of difference, and our idea of a high caliber group is one that is just like us. And that's not entirely facetious in that we basically want shareholders who look at the business the same way we do, because we're going to be around running something, and what could be worse than having a group out there had a whole different set of expectations than we did, and that evaluated us in a different way, or all of this sort of thing. I mean, if you are going to you're going to have a given number of shares outstanding. Let's say we have the equivalent of 1,200,000 and some thousand A shares. Somebody's going to own every single share. Now, would you rather have them owned by people who understand your business, who understand your objectives, who measure you the same way you do, who have similar time horizons, or would you rather have the reverse? It makes a real difference over time to be in with people that are compatible with you. So it's a significant plus to us, the operation of the business, and it leads to a more consistent relationship between price and intrinsic value when you have a group like that, because they understand themselves and they understand the business, and they're not likely to do silly things in either direction. So you get a much more consistent relationship than if we had a whole bunch of people who were thinking that the most important thing in evaluating this business was next quarter's earnings. The question about McDonald's simply is, it's an outstanding business, and we don't talk about it when we buy it. We don't talk about it if we sell it. Charlie?
Yeah, the question of what difference does it make to the management who the shareholders are? Well, if you are into what I call trustee capitalism, where the shareholders aren't just a faceless bunch of nothings, but you feel as a kind of a hair shirt an obligation to do as well as you can by the shareholders. Well, wouldn't you rather feel an obligation to people you liked instead of people you didn't like?
Yeah, let's say you were running a business and you had a choice of 3 owners. You could have 100% of it owned by whatever your favorite philanthropy is. You could have 100% of it owned by the U.S. government, and you could have 100% owned by the worst person you can think of in your hometown. I mean, I think it would make a difference in how you felt about going to work every day. Number 9.
Yes, my name is Steve Check. I'm from Southern California, and my question has to deal with kind of quality versus price. I've been to 3 annual meetings and have heard great things about Coke every year, but as far as I'm aware, you have not bought any additional shares of Coke over the last 3 years, even though the stock has done just fine. If an investor has a relatively short time frame, say 3 to 5 years, how much weight do you think one should give to quality versus price?
Well, if your time frame is 3 to 5 years, I wouldn't advise it being that way, because I think if you think you're going to get out, then it gets more leaning toward the bigger fool theory. The best way to look at any investment is how will I feel if I own it forever, and put all my family's net worth in it. But we basically believe in buying, if you talk about quality, meaning the certainty that the business will perform as you expect it to perform over a period of time, so the range of possible performance is fairly narrow. That's the kind of business we like to buy, and all I can say is that we like to pay a comfortable price, and that depends to some extent on what interest rates are. We haven't found comfortable prices for the kind of businesses we like in the last year. We don't find them uncomfortable in the sense that we want to sell them, but they're not prices at which we added to Coke one time about, I don't know, 5 years ago or thereabouts, and it's conceivable we would add again. It's a lot more conceivable we would add and subtract. But that's the way we feel about most of the businesses. We did make a decision last year that we thought bonds were relatively attractive, and we trimmed certain holdings and eliminated certain small holdings in order to make a bigger commitment in bonds. Charlie?
Yeah, you talk about quality versus price. The investment game always involves considering both quality and price, and the trick is to get more quality than you're paying for in the price. It's just that simple.
But not easy.
No, but not easy.
Area 10.
Gentlemen, good afternoon. Jeff Kirby from Green Village, New Jersey. Would you comment, please, on tax-free spin-offs to shareholders in general, and particularly how you would feel about those were you to believe that a materially higher value would be ascribed to one of your operating companies in the public arena than as part of Berkshire Hathaway?
Well, there's certainly been times in Berkshire's history when certain components of Berkshire might well have sold at higher multiples as individual companies than the amount they contributed to the whole of Berkshire, although I don't think that would be the case now. But our reaction to spin-offs would be, even if we thought there was some immediate market advantage, it would have no interest basically to us. That we like the group of businesses we have as part of a single unit at Berkshire. We hope to add to that group of businesses. We will add to that group of businesses over time. And the idea of creating a lot of little pieces because we could get a little more market value in the short term, it just doesn't mean anything to us. Charlie?
Yeah, it would add a lot of frictional costs and overheads. And we have I don't know of anybody our size who has lower overhead than we do. And we like it that way.
Yeah, right now our after-tax cost of running the operation has gotten down to a half a basis point of capital value. When you think that many mutual funds are at 125 basis points, that means they have 250 times the overhead ratio to capitalization that we have.
And all they got's a bunch of marketable securities, and we got that plus businesses.
Yeah. We don't need any more.
But we can get lower, Warren. We can get a lot lower.
I know. You think they'd work for $500 a year instead of $900, Joe? Groans from the front row. Area 1.
Good afternoon, Mr. Buffett and Mr. Munger. I was kind of curious if you could tell me, do you know or can you tell us how much business Nebraska Furniture Mart and Board tell me, do you know or can you tell us how much business Nebraska Furniture Mart and Board investing in the auto industry, and if not interested now, what would change your mind about this industry in the future?
Well, the first question, I don't know what the Mart did, but I do know they had a lot of shareholders there. I've gotten a verbal report on that. There would be less change in their normal business. They do, you're talking about a company that at the Mart that does $800,000 a day on average. It is a big operation. So our shareholders have an impact, but not the relative impact that they would have at Borsheim. Borsheim's did over twice as much this year as last year, and they had a big day. And what was the other question, Charlie?
Industry. The auto industry.
Oh, the auto industry. Yeah, Charlie was big in General Motors in the mid-'60s, right, Charlie? And was your biggest commitment?
I had a temper. Luckily, it passed.
Yeah. No, he made money on it.
Yes, I did.
It's kind of industry it's interesting for us to follow. I mean, many years ago, it was the dominant factor or overwhelming factor in the economy. It's diminished a fair amount, but it's still a very important industry, and it's the kind of industry that anyone can follow. I mean, you have experience with the product and competing products, and everyone in this room understands in a general way the economic nature of the industry, but we've never felt that we understood it better than other people. So we've seen auto companies at very low multiples sometimes, and with prices that in hindsight look very attractive, but we've never really felt that we knew who among the auto companies 5 years from now would have gained the most ground relative to where they are now, or to gain the most ground relative to what the market might expect. It just isn't given to us, that knowledge. Charlie?
I agree.
Area 2.
Hi, my name is Scott Rudd from Eden Prairie, Minnesota. And my question is this. 10 years from now, and I'm referring to Borsheim's as the retail part of it to the consumer, not so much the corporate division. 10 years from now, what would be the 3 things that you would expect division? 10 years from now, what would be the 3 things that you would expect on a day-to-day operating basis to change the market?
Are you talking about Borsheim specifically?
Yes.
I think Borsheim's, I don't know about 3 things, but Borsheim's may be one of a couple of our companies where the internet could be have a huge potential for us. I don't know if that'll happen, but there's no question that we operate, and I've got a message on the internet that at very considerably lower gross margins than does a Tiffany or publicly held jewelry operations. We are giving customers considerably more for their money. We've got way lower operating costs than the public companies. And I say on the internet, our operating costs are 15 to 20 percentage points, and even more in some cases, less than publicly owned competitors. So we've got a lot to offer. Now, the big question people always have with jewelers is, how do you know who to trust? I mean, it is an article that most people feel very uncomfortable buying, and I think that the Berkshire Hathaway identification can help people feel comfortable on it. I think that the experience of customers around the country as they see it, and I don't think that I think it is a product. It's a high ticket item, so saving money gets to be really important, just like auto insurance. Saving money gets to be really important. So I think that the internet could be of significant assistance to Borsheim's in terms of spreading and facilitating its nationwide reputation. So Borsheim's could have a lot of growth, and the internet could be a big part of it. Our job is to get the message to people around the country that they can literally, have us send half a dozen items to them that they can look at with no high pressure salesmanship at all or anything of the sort, and look at the prices, decide what they want, in their own what they want in their own homes, and they will do very well with us. Of that now, but we could have 10 or 20 or 50 times that number as the years go by, and I think we should work very hard on that. GEICO has possibilities through the internet, obviously, also. But anything where you're offering a terrific deal to the consumer, but one of the problems has been, how do you talk to that consumer? The internet offers possibilities. Now the thing is that everybody in the world is going to be there, and why should they click on you instead of somebody else? Actually, the Berkshire Hathaway name may help a little bit on that, although GEICO's name is extremely well known. GEICO is I said in the annual report we were going to spend $100 million basically in promotion this year. We'll spend more money than that. The brand potential in GEICO is very, very big, and we intend to push and push and push on that. Charlie?
Well, all that said, if the internet helps some of our business, well, certainly the CD-ROM and the personal computer combined to clobber World Book for us.
Yeah, we paid our entry fee.
Yeah, It's not all plus.
No. Area 3.
My name is George Gatti from Zurich, Switzerland, and my question refers to two food businesses, namely McDonald's and Dairy Queen. Are there major differences in the investment characteristics between McDonald's and Dairy Queen? And if yes, would you explain them?
Yeah, there are.
McDonald's and Dairy Queen, and if yes, would you explain them?
Yeah, there are major differences. McDonald's, I can't tell you the exact percentage, but if they've got 23,000 outlets, they own many, many thousands of them and operate them. And then of the remainder, they own a very high percentage and lease them to their operators, their franchisees. So they have a very large investment on which they get very good returns in physical facilities all over the world. Dairy Queen has, counting Orange Julius, 6,000 plus operations, of which 30 odd are operated by the company, and even those, some are in joint ventures or partnerships. So the investment in fixed assets is dramatically different between the two. The fixed assets investment by the franchisee or the person as landlord obviously is significant at a Dairy Queen, but it's not significant to the company as the franchisor. So that the capital employed in Dairy Queen is relatively small compared to the capital employed in McDonald's, but McDonald's also makes a lot of money out of owning those locations and receives, whereas Dairy Queen will in most cases receive 4% of the franchisee's sales in terms of a royalty. At a McDonald's, there's that more than that percentage plus rentals and so on. So they're two very different economic models. They both depend on the success of the franchisee in the end. I mean, you have to have a good business for the franchisee to over time have a good business for the parent company. Both companies have that. To over time have a good business for the parent company. Both companies have that. Charlie?
Is not very much when you stop to think about providing a group of franchisees with a nationally recognized brand and quality control and all sorts of desirable business aids.
No, 4% is at the low. If you look at the whole industry, 4% is in the lower part of the range. But
part of what attracted us.
Yeah.
Part of what attracted us was the fact that part of what attracted us.
Yeah.
Part of what attracted us was the fact that
sell his operation for significantly more than he has invested in tangible assets, and we want it that way, obviously, because that means he's got a successful business, and it means that over time we will have a successful business. You want a franchise operator. You want the franchise operator to make money, and you want him to create a capital asset that's worth more than he's put in it. That's the goal. Area 4.
Good afternoon, Mr. Munger and Mr. Buffett. My name is Patrick Byrne. I'm a shareholder, and I'm here from Cincinnati, Ohio. Back again this year to ask a question to see if I can get the two of you to disagree on a subject. I've picked education as an area where we might see some daylight between the two of you. First, though, on the subject of education, I'd like to offer some brief thanks. I'm lucky in that my parents in the late 70s made a wise choice of buying some Berkshire stock and putting it in a college fund for my brothers and me, and that basically paid for our higher education. I suspect there must be thousands of people like us who had our education paid for by wealth that the two of you created, and we owe you, although we'd probably all have been a lot better to skip college and keep the stock. Well, on the subject of education, Milton Friedman has said, or has written, that if you really care about poverty in the U.S. and the disadvantage of women and minorities and so on, and you could cure one single thing in the U.S., it would be the public education system. Mr. Buffett, of course, you've been very publicly supportive and done many things, and I'm sure Mr. Munger has as well, for public education. But I noticed last year in this annual meeting, Mr. Munger, well, both of you, I noticed last year in this annual meeting, Mr. Munger, well, both of you business schools, but Mr. Munger, he was a tad critical, I would say, of the U.S. public education system. And I wonder if you two agree with what Friedman says and what you think the importance of public education is and what might be done to improve it.
I'm going to let Charlie go in a second, but I just want to say Patrick Byrne is the son of Jack Byrne, who made a fortune for us by resuscitating Geico when it got into trouble in the mid-'70s. In fact, I met Patrick's dad on a Wednesday night about 8 o'clock at night in Washington when Geico was bankrupt, and it was very close to being declared so. And after talking with about 3 hours that night, the next day I went out and bought 500 and some thousand shares of Geico that Davey referred to at 2 1/8, so which is 40 cents on the stock that we paid $70 for later on. So Patrick's dad, we may have made the Byrne family a little money. He made us a lot of money. Patrick is now running Fetchheimer's in Cincinnati and doing a sensational job. His brother Mark, on June 30th, if we hit the target date, will be establishing a major operation in London and Bermuda that will in which we will be a very large partner. So he's only got one other brother left, and he's out playing golf in California. But if times get tough, we're going to try and recruit him too. Now, Charlie, with all that time to prepare, what do you have to say about education?
Well, I certainly agree with Milton Friedman that it would be hard to name one factor, if we could fix it, that would be more worthy of fixing than particularly the in education, where the failures are so horrible in many big cities particularly. So yes, I think it's a terrible problem, and it needs fixing. Of course, there's a huge debate as to what the best way is to fix it. And I am skeptical myself of big city school systems getting fixed under their own momentums. In other words, I'm quite sympathetic to the people who say we may have to go to an alternative like vouchers, that the incentive structure has gotten so bad in some places that you can't fix it with evolution. It takes revolution. Warren, you're more optimistic about
well, I'm not necessarily more optimistic. I probably feel, though, that democracy without a good public school system available to the entire population is sort of a mockery, because there's so much inequality to start with. I mean, it isn't just inequality of money, but I mean, my kids, whether they inherit any money, or your kids, whether they inherit any money, compared to the kids of somebody where both parents are struggling to keep the place going, or maybe just one parent and living in poverty. I mean, it is so unequal to start with that if you accentuate, maybe just one parent and living in poverty. I mean, it is so unequal to start with that if you accentuate giving those who are generally higher up, who have chosen the wrong womb, I think that's just, I don't think the society should tolerate that, or a rich society should tolerate it. That doesn't mean it's easy to solve, because I've said a lot of times that, unfortunately, that it seems like a good public school system is like virginity, that it can be preserved but not restored. And it's very hard when you get a system that's lousy, to do much about it, because under those circumstances, the wealthy people are going to all opt out of the system, and they're going to be less interested in the bond issues. They're going to be less interested in the PTA. They're going to be less interested. All opt out of the system, and they're going to be less interested in the bond issues. They're going to be less interested in the PTA. They're going to be less interested in the other people's children if they have all opted out. And another for the poor, with the poor being getting the poorer system strikes me as doing nothing but accentuating inequality and other problems that result from that in the future. So I don't know the answers on improving the system. I read some of the experiments that take place, but I do believe, to start with, that if you have a good public school system as we do in Omaha, that you do your damnedest to maintain that, so that there is no incentive for the rich grandparent or the rich parent to say, I love the idea of equality, but I love my grandchildren or my child more, so I'm going to yank him from the public school system. And then you get this sort of exodus, which leaves behind only those who can't afford to make that choice. If there were a way, the idea of competition I like, and I think a good parochial system does, for example, create a better public system. And I think we've had that situation in Omaha. But I think the voucher system, if it simply amounts to giving everyone an additional amount, simply means that the rich get X dollars of the public school system subsidized, but the poor still are, whatever that differential is, remains. I mean, you could have a golf voucher system, because I play golf. I don't play very often, but if I play at the Omaha Country Club, and you could have a system, because I play golf. I don't play very often, but if I play at the Omaha Country Club, and you could have a voucher system so that everybody in Omaha would have more access to wouldn't do the job for the guy who's on the public course, because he'd still be beyond his means to move to full-scale equality with me. I don't think there's anything more important, and I agree with Charlie totally. I think the first 8 grades, you can forget it after that. If you have the first 8 grades right, good things are going to flow, and if you have those wrong, you're not going to correct it as you get beyond that point. And I think that wrong, you're not going to correct it as you get beyond that point. And I think that on the $500 million, I think it is very tough to see results, producing results. I think it should be replicated elsewhere. I think that obviously a fellow in Chicago says that the unions have caused considerable problems in getting adjustments made, but he had the political clout behind him to overcome some of those problems. It ought to be a top national priority. We have the money to educate everybody well in this country, and the question is if we got, can we? And that's something I hope good minds like Patrick's work on. Charlie, you have anything for that?
Yeah. I think when something is demonstrably failing at performing the function to which it's assigned by a civilization, just to keep pouring more and more money into a failing modality is not the Munger system. So I'm all for taking the worst places where there's failure and trying a new modality. And it wouldn't bother me at all to have vouchers only for the poor. But I think we have to do something in our most troubled schools to change our techniques. I think it's insane to keep going the way we are.
So you go for means-tested vouchers, basically.
Well,
I don't disagree with that idea.
But all I know is where it is a terrible place to fail, and part of the trouble is ideological. If you have a absolute rule, there can't be any tracking by ability, no matter how much better reading can measurably be taught by systems that involve tracking. Well, people that brain blocked shouldn't have the power. We should do what works.
No, we got plenty. I mean, Omaha it works. The problem is that once it gets beyond a certain point on a downhill slope, essentially you have the citizens that are able to do something about it essentially opt out, and that I don't know.
I am a product of the Omaha Public Schools, and in my day, and The people who went to private schools were those who couldn't quite hack it in the public schools. That is still the situation in Germany today. I mean, private schools are people who aren't up to the public schools. I prefer a system like that. But once a big segment of that system measurably fails, then I think you have to do something. You don't just keep repeating what isn't working.
Well, I agree with that. Patrick, have you gotten your answer? Let's go to Area 5.
My name is Kevin Murphy. I'm from Camarillo, California, and my question is, what do you look for when determining if a person is honest or not?
Well, that's a good question, Kevin. I think generally Charlie and I can do pretty well with the situations we see, but we have to have some evidence of behavior in front of us, and I would say even there's some occupations where we're going to expect to find a higher percentage of people who behave well than in others. But if we work with someone over a period of a few months or more, I think we can come up with a pretty high batting average in terms of how they behave. At Solomon, I think I was able to separate out the people who I felt very good about and the people I was a little more nervous about fairly quickly among the ones I worked with actively. But how you spot that precisely, leave your lunch money on their desk sometime. Yeah, maybe you'll find out in a hurry. But we like people. The great example, is somebody like a Tom Murphy, where they're just bending over backwards all the time to make sure that you get the better end of the deal, or that doesn't mean they aren't competitive. I mean, if you play him a golf game for money or something like that, he wants to win the worst way. But there are people that just they don't take credit for things that they didn't do. In fact, they give you credit for some of the things that maybe they did, and you can get a feel for it over time. And Charlie, you have any good guidelines on that?
Yes, I think that people leave track records in life, and so somebody at your age should figure that by the time he's 22 or 3, well, he will have left quite a track record, and the world will be able to figure you out. So I think track records are very important, and if you start early trying to have a perfect record and in some simple thing like honesty, you're well on the way to success in this world.
Johnny Agnelli one time told me, he said, when you get older, you have the reputation you deserve. He says you can get away with it for a while early on, but by the time anybody gets to be 60 or so, they very probably have the reputation you deserve. And the truth is, you can have the reputation that you want. If you list all of the things that you admire in other people, you'll find out that almost everything you list, you may not be able to kick a football 60 yards or something of that sort, but almost everything you list in the people that you admire and like, they're qualities that you can have if you just set out to do that. And didn't Ben Franklin do that, Charlie?
No, sure. I always say that to get what you want is to deserve what you want.
I'll have some more peanut brittle. Area 6.
I'm Nancy Sell from Atlanta, Georgia. You were asked early this morning a question about the year 2000 computer problem. Do you anticipate any negative financial impact to the economy or to our companies due to the Millennium Problem? And if so, what financial strategies are you considering?
Well, I don't think there'll be major problems for our companies. There are going to be some problems anytime you have something that big. If people didn't see it coming in 1980 or 1985. They're not going to be perfect at solving it by 2000. You can count on that. But I don't think it has any investment consequences for Berkshire Hathaway that we should be considering now. And I do think you'll see most of the problems in the governmental area. You know, maybe they won't find your tax return for 2 or 3 years. Who knows? Charlie? Yeah. Area 7.
In your description of McDonald's, you have the sense that there's a great business buried in McDonald's, and there are 2 good businesses that are mixed in with it. And the problem is with the real estate and the operational business, that as the company is currently capitalized, they can't earn the same kind of returns they can earn in the franchising business. You were or still are a significant shareholder of McDonald's. I guess my question is, the solution is obvious. Why don't you push for a solution that creates the same opportunity you have at International Dairy Queen?
Well, my guess is, I don't know the details on it, but my guess is that with 23,000 locations all over the world, I think it would be extraordinarily difficult to separate the real estate business out from the franchising business at this point. I think they could have gone a different route. I'm not saying it would have been a better route at all. In fact, I think the odds are they followed the right route in owning and controlling so much real estate. But I just think the problems would be horrendous. Certainly you wouldn't want to sell it and lease it back, because you would not end up with more value, in my view, by doing that. And spinning it off in a real estate trust or something with operating in 100 plus countries, and with all of the franchise arrangements, I think it would be a huge problem. I would not want to tackle it myself. So I think that you should look at McDonald's, and I don't know anything about their plans on this, but I think you should look at McDonald's as being a very good business, but the one that will continue in its present mode vis-a-vis the real estate, although I think they've signaled that they're going to do less on new properties, somewhat less in connection with ownership than they've done to this point. But there's 23,000 locations out there, and every operator, his own arrangement is very important to him, and it would be a mammoth job, and I'm not sure how much extra value would be created in the end anyway. Charlie?
Yeah, the net returns on capital McDonald has earned all these years are high, even though they have owned a lot of the real estate. I think it's hard to quarrel with the way they did it. They had the best record.
And the multiple is not greatly different, in my view, than if the real estate were separate. You know, I mean, now if you get all the real estate de-taxed in some arrangement, you might get a little more out of it, but it doesn't strike me as a big deal. But, Area 8.
Yeah, hi, I'm Rachel White from Missoula, Montana, and during the lunch break I heard some people talking about double taxation and how that impacts Berkshire's investment philosophy. So I was wondering if you could talk a little bit about it. I'm not sure I understood it, and if you could explain whether that impacts your investments.
Well, we are structured very poorly, if you were looking, if you're going to start all over again and do most of the things we've done, you'd probably not do it in corporate form or precisely like we do it. I mean, what that gentleman was talking about in connection with McDonald's applies much more to Berkshire Hathaway, even by far, than McDonald's in terms of de-taxing part of the income stream. If we own Coca-Cola with a cost of $1.2 billion or $1.3 billion and a market value of $15 billion, we're not going to sell it. But if we did sell it, we would incur a capital gains tax on the order almost of $5 billion. That means that the 15 becomes 10 billion. Now, if that 10 billion is reflected in Berkshire's value, and you bought your stock when we bought our Coke, then you pay a second tax in turn in reflection of the Coca-Cola appreciation that's taken place after tax. So it's a very disadvantageous way of owning securities to have a corporation in between you and the securities themselves. If we ran as a partnership, that would not be the case. I ran Buffett Partnership for many years. and we only had one tax at the individual level. So our stockholders are, to the extent that we own marketable securities, and we own a lot of them, and to the extent that we have a lot of profits over time in those, own those securities in a disadvantageous way. Now, we also have a float, which helps us own them, which is a big plus. But corporate ownership of securities, if you have the option of owning them directly or through a partnership, corporate ownership is disadvantageous, and we're stuck with it. We've had it for all these years. We've got no plans to do anything about it. We couldn't probably do anything about it if we wanted to. So that is a drag on our performance compared to what would be the situation if we operated as a partnership. And Lloyd's syndicates, for example, didn't have that problem. Some insurance companies that operate in Bermuda may not have that problem to the same extent. Certainly partnerships don't have that problem to the extent they own securities. But it's a fact of life with us, and we're going to pay a lot of taxes. Charlie?
No, we have no cure for the corporate income tax, and it is a big disadvantage for the indirect owner of securities. So far, we've surmounted it well enough, but we're carrying a load there.
It's become a bigger disadvantage since the individual rate went to 20%, with our corporate rate being 35%. Because if we make $1 on a stock, it becomes 65 cents, and to the extent that you've owned Berkshire, that 65 cents now 20% off that becomes 52 cents, whereas if you'd owned the stock directly, you'd have had 80 cents. Now, when we owned Geico and it wasn't consolidated with us, you carried that one more extreme. I mean, Geico had capital gains, and we had a capital gain proportionally in Geico, and so on. I mean, how you're structured does make a real difference, but usually once you get into a given structure, you're kind of stuck with it, as I indicated in the answer to the gentleman on McDonald's.
Now, to the extent we have very long holding periods at the corporate level, the real mathematical disadvantage shrinks.
Yeah, and we might not have been able to get the float that we have if we hadn't been operating it in a corporate structure, so that is a mitigating factor too. But we like to have the mitigating factors without anything to mitigate if we get our choice. Area 9, please.
Good afternoon. My name is Fred Strassheim, and I'm from here in Omaha. I have a question about your acquisition methodology, and I was intrigued to read in your annual report about your acquisition of Star Furniture. And as I understand the process you followed, Mr. Buffett, you met with you reviewed financials for a brief period, liked what you saw, then you met with Mr. Melvin Wolf for 2 hours and struck a deal, and you wrote you had no need to check leases, work out employment contracts, etc.
Right.
I think that most companies, when they do acquisitions, would feel the need to do a significant amount of legal due diligence, to do things like check the leases, check into things like undisclosed environmental liability, or perhaps threaten litigation. And I guess my question is, have you ever been burned by your approach?
We've never been burned by we've been burned only in the sense that we've made mistakes on judging the future economics of the business, which would have had nothing to do with due diligence. We regard what people normally refer to due diligence as really sort of boilerplate in most cases. It's a process that big companies go through, and they feel they have to go through it, and they're ignoring, oftentimes in our view, they're ignoring what really counts, which is evaluating the people they're getting in with it and evaluating the economics of the business. That's 99% of the deal. You know, you may run into an environmental liability problem, one time in 100, or you may find a bad lease. I asked Melvin about, do you have any bad leases? I mean, that's the easiest way to do it. And I can read them all and try and look for every clause or something, but it isn't going to, that is not the problem. We've made lots of bad deals. We made a bad deal when we bought Hochschild Kohn, for example, a department store operation back in 1966. But it had fine people, but we were wrong on the economics of the business. But the leases didn't make any difference, or that sort of thing just was not important. And I can't recall any time that what other people referred to as due diligence would have avoided a bad deal for us.
I can't either.
No, that's 30-some years. And the key thing, you just don't want to do. I go into. I'm on various public company boards. I've been on 19 public company boards, and their idea of the due diligence is to send the lawyers out and have a bunch of investment bankers come in and make presentations and all that. And I regard that as terribly diversionary, because the board sits there, entranced by all of that, and everybody reporting how wonderful this thing is and how they've checked out patents and all that sort of thing, and nobody is focusing really on where the business is going to be in 5 or 10 years. And business judgment about economics and people to some extent, but the business economics, that is 99% of deal making, and the rest. People may do it for their protection. I think too often they do it as a crutch, just to go through with a deal that they want to go through with anyway. And of course, all the professionals know that. So believe me, they come back with the diligence, whether due or not. And we are not big fans of that. I don't know how many deals we've made over the years, but I cannot think of anything that traditional due diligence has had a thing to do with. And
no, we've had surprises on the favorable side a couple of times.
That is true. That is true. The kind of people that we've generally dealt with have usually told us the bad things first and good things after we made the deal. We made a deal with a fellow over in Rockford in 1969, Eugene Abegg, the Illinois National Bank and Trust Company. I made that deal in a couple of hours, and I mean, there just wasn't any way that Gene was going to be hiding anything bad. For the next 10 years, when I went over there, every time I go to lunch, he'd point out some building in town that we owned that wasn't on the books, or some foundation we had that had money in it that he hadn't told me about. And he even gave me some bills, one of which I carry in my pocket, that he had still sitting around that were issued by the bank, that were our own money, which he never told me about. We could cut them out like paper dolls. I mean, Gene was not a guy to show all his cards. And those are the kind of people we've generally dealt with. And I would certainly say that that Melvin and Shirley fit that description in spades. We're now at 3:30. It's been a lot of fun this weekend. I'm glad you came, and I hope to see you next year. Thank you.